Continuing our coverage of the December payrolls report yields right now, they are moving higher. And we're joined by Blake Gwinn, who's the RBC Capital Markets head of U.S. rate strategy. You say that the possibility of a January cut is dead. DOA, when do you see the next Fed's policy move here going forward?
Well, I mean, to be fair, that January cut was already nearly dead before this print. Now we're probably looking at that March print. I think there's been an assumption in the market that basically since that hawkish December FOMC, we've largely priced out January, and I think market participants have been kind of thinking about this quarterly pace. So the Fed kind of skipping January, coming back in March, and just basically slowing down to every other meeting instead of every meeting. I think this really challenges that. When I look at March, the last 2 years we've seen very strong seasonality in the Q1 data. It's come in very, very hot. If you look 2 years back, it led Powell to start talking about the potential for 50 basis point hikes again. Last year, the Q1 seasonality saw us price out about 140, 150 basis points of rate cuts from December, to April. If we get a repeat of that, I find it very hard to think that the Fed's going to be able to come back in 2 months, sitting on potentially 2 more months of hot data and deliver another cut. So I think they're done here.
Blake, we have the bond market reaction here to this print on the screen right now, and that's really what's driving a lot of today's action, a lot of the commentary and focus here on the street, because you got the 10-year just shy of that 4.8 level. You got the 30-year hitting that 5% level for the first time since November of 2023. What does that tell you?
I think it's actually the most interesting thing to me is the front end move today. And I say that because I think there was probably a good case for NFP where, it was just a little bit above consensus, where we saw a continuation of some of the price action we've seen over the last few weeks, which is that the front end yields remain kind of pegged. The market seems kind of unwilling to price out, more cuts. We've been kind of pegged at, let's call it the effective Fed funds rate, 2-year, can't really move above that unless the market really starts to consider the possibility that the Fed could hike sometime in the near future. So we've been kind of pegged at the front end, meaning that all the good data, all the hawkish Fed, any kind of sell-off is really hitting the back end more. And so we've seen that bear steepening. So I think there was a case today where NFP was just okay. The front end remains kind of pegged and most of the sell-off was in the back end. This was so good that I think now we're actually seeing that front end, experience more of the moves. So that's actually surprising to me. If you would have told me there was a beat today, I would have expected more of that bear steepening where the back end is selling off more. And instead, we're actually challenging that front end ceiling a bit.